Between January and October 2024, something extraordinary happened that most people completely missed. The world witnessed the largest voluntary transfer of private capital in modern history. Not through war, not through government seizure, through choice. 16,500 millionaires left the United Kingdom in 2025. That is the highest single-year exodus ever recorded from any country in history. They took with them an estimated $92 billion in liquid investable assets, just walked away. China lost 15,200 millionaires in 2024. France is bleeding wealth. Germany is watching capital flee. And the pattern isn't slowing down. It's accelerating. Meanwhile, the UAE gained 9,800 high net worth individuals in a single year. Singapore attracted thousands more. The United States, despite political chaos, pulled in 7,500 millionaires. Switzerland continues managing $2.4 trillion in offshore wealth for foreigners. This isn't random migration. This is a coordinated, strategic repositioning of global wealth happening right now at a speed and scale never seen before. And if you think this doesn't affect you because you're not a billionaire, you're about to discover why you're wrong. Because when the wealthiest people on earth are running this fast from their home countries, they're seeing something you're not. They have access to data, advisors, and information that tells them the systems holding your wealth are about to break. And they're positioning to survive what's coming while you're left holding assets that will evaporate. Let me show you exactly why billionaires are moving money offshore at record speed, what they're running from, where they're running to, the mechanisms they're using that you've never heard of, and what this mass exodus means for your savings, your currency, and your economic future. Because this story isn't about rich people playing financial games. This is about the collapse of trust in the countries that have dominated global wealth for centuries. Before I show you the current exodus, you need to understand what offshore actually means. Because the word has been deliberately obscured by media and governments to make it sound illegal, immoral, or shadowy. It's none of those things. Offshore simply means placing assets in a jurisdiction outside your country of residence. That's it. If you're American and you buy real estate in Portugal, that's offshore. If you're British and you have a bank account in Singapore, that's offshore. If you're Chinese and you invest in Swiss bonds, that's offshore. The reason it's called offshore is historical. In the 1960s, American banks set up operations in the Caribbean islands off the coast of Florida to avoid U.S. banking regulations. The Cayman Islands, the Bahamas, the British Virgin Islands, these were literally off the shore. The name stuck. Even though today's offshore centers include landlocked Switzerland, desert city-states like Dubai, and Asian financial hubs like Singapore and Hong Kong. Here's what offshore provides. First, asset protection. If you're a business owner in a country with weak rule of law, offshore structures protect your wealth from arbitrary seizure, frivolous lawsuits, or political retribution. Second, tax optimization. This is not tax evasion. It's using legal structures in jurisdictions with favorable tax treaties to minimize your overall tax burden. Third, currency diversification. If your home currency is collapsing, offshore accounts in dollars, euros, or Swiss francs preserve value. Fourth, privacy, not secrecy. Privacy. The ability to conduct financial affairs without every transaction being monitored by governments that increasingly treat citizens as sources of revenue rather than individuals with rights. And here's what most people don't understand. The wealthy don't use offshore to evade taxes. Modern offshore centers operate under strict international compliance frameworks. The Common Reporting Standard, FATCA, know your customer requirements, anti-money laundering regulations. Every major offshore center now automatically reports account information to the account holder's home country. In 2024, over $12.6 trillion in offshore financial wealth was reported to governments globally under these transparency agreements. The actual tax evasion from unreported offshore wealth has fallen from 10% of global GDP in 2013 to about 3% today. That's a 70% reduction in a decade. So when billionaires move money offshore today, they're not hiding it. They're strategically repositioning it in jurisdictions that offer legal protection, favorable tax rates, political stability, and economic freedom that their home countries no longer provide. And they're doing it at record speed because the conditions in their home countries have become intolerable. Now, let me show you the numbers, because the scale of what's happening is staggering. The United Kingdom is experiencing what analysts call Wexit, wealth exit. In 2024, 10,800 high net worth individuals left the UK. What changed? In February 2022, the UK closed the Tier 1 investor visa. This eliminated a key pathway for wealthy foreigners to move to Britain. Then, in March 2024, the Conservative government overhauled the non-domicile tax regime. This was the system that allowed foreign nationals living in the UK to avoid paying British taxes on their foreign income. For decades, this made Britain attractive to international wealth. Gone then in October 2024, the Labour government announced changes to inheritance tax rules that would hit wealthy families harder. The combination of these three policy shifts triggered panic. Applications for alternative residence and citizenship programs through Henley & Partners, the largest investment migration firm, increased 183% from UK nationals in the first quarter of 2025 compared to 2024. Where are they going? The UAE, the United States, Italy, and Switzerland. The UK is now losing more millionaires annually than any country in history, and the capital drain is accelerating. China presents a different story. In 2022 and 2023, China was losing over 15,000 millionaires annually. The exodus was driven by economic uncertainty, geopolitical tensions with the West, crackdowns on tech and finance sectors, and COVID lockdown policies that terrified wealthy Chinese citizens about government overreach. But in 2025, the outflow slowed to 7,800 millionaires. That's still a massive loss, but it's the lowest in years. Why? Two reasons. First, China's tech sector in Shenzhen and Hangzhou is booming again. Growth in private banking, healthcare, and entertainment industries is creating opportunities. Second, the Chinese government is making it harder to move large amounts of capital out of the country. Capital controls. But here's the key. The 7,800 millionaires still leaving in 2025 are the ones who can afford the complexity and cost of navigating those controls. They're using cryptocurrency, offshore trusts, foreign real estate purchases, and shell companies to move wealth despite restrictions. The fact that they're willing to go through this complexity tells you how desperate they are to get money out of China. France is bleeding wealth too. High taxes, bureaucratic red tape, and political instability are driving French millionaires to Switzerland, Belgium, and Portugal. Germany is watching capital flee to Austria and the UAE. Russia has been hemorrhaging millionaires since the Ukraine war started. Over 15,000 left in 2023 alone, escaping sanctions and economic chaos. And here's the part that should terrify Western governments. The United States is both gaining and losing millionaires simultaneously. America is attracting 7,500 high net worth individuals in 2025, but American nationals represent over 30% of all investment migration applications worldwide. That's the largest source market by far. Applications from Americans for alternative residence and citizenship programs increased 200% in the first quarter of 2025 compared to 2024. What does this mean? Wealthy foreigners are still moving to America, but wealthy Americans are positioning Plan B options offshore faster than ever before. They're buying citizenship in Portugal, Malta, Antigua. They're setting up residency in Dubai, Singapore, Monaco. They're not leaving America yet, but they're building escape routes. And when the wealthiest Americans who have the most to lose start building exits, that's not optimism. That's hedging against collapse. Now, where is all this wealth going? Three destinations dominate: the UAE, Singapore, and Switzerland. Let me show you why. The UAE, particularly Dubai and Abu Dhabi, is the #1 wealth magnet in the world. 9,800 high net worth individuals moved to the UAE in 2024. They brought an estimated $63 billion in assets with them. Why? Zero personal income tax. Zero tax on dividends. Zero tax on capital gains. Golden visa programs that provide long-term residency for investors, entrepreneurs, and skilled professionals. World-class infrastructure. Luxury real estate at competitive prices. Political stability in a region that historically has been volatile. And most importantly, the UAE has positioned itself as neutral ground between East and West. When US-Siena tensions escalate, the UAE doesn't pick sides. When Russia faced sanctions, the UAE remained open for business. When Europe imposed capital controls, the UAE welcomed the capital. This neutrality is invaluable. Wealthy individuals don't want to be trapped in geopolitical conflicts. They want to be somewhere they can access both Western and Eastern markets. The UAE provides that. Singapore is the second major destination. 3,600 millionaires moved to Singapore in 2024. Singapore combines political stability, rule of law, a sophisticated financial system, and favorable tax treatment. The top personal income tax rate is 24%, but through legal structuring, effective rates can be much lower. Singapore has no capital gains tax. It operates a territorial tax system, meaning income earned outside Singapore isn't taxed. Singapore also offers access to Asian markets. If you're a European or American investor who wants exposure to China, India, Southeast Asia, you base yourself in Singapore. The city-state has become the Switzerland of Asia. And unlike Switzerland, Singapore is growing faster. Its millionaire population increased 62% over the past decade. Switzerland remains the gold standard for offshore wealth. Switzerland manages $2.4 trillion in offshore wealth for foreign nationals. That's more than any other country. Swiss banks have operated for centuries with a reputation for stability, discretion, and competence. Switzerland's political neutrality, strong franc, and legal protections for wealth make it the default choice for ultra-high net worth individuals. But Switzerland is expensive. High cost of living, complex residency requirements, and increasing pressure from the EU and US to share tax information. That's why newer destinations like the UAE and Singapore are growing faster. But for pure wealth storage, Switzerland remains unmatched. Now, the mechanisms billionaires use to move wealth offshore have evolved dramatically. This isn't briefcases of cash. This is sophisticated legal structuring that exploits legitimate gaps in international tax law. First, offshore trusts. A trust is a legal arrangement where you transfer ownership of assets to a trustee who manages them for the benefit of beneficiaries. By placing assets in an offshore trust in jurisdictions like the Cook Islands, Nevis, or Jersey, you create legal separation between yourself and your wealth. This protects assets from lawsuits, creditors, and even divorce settlements. Offshore trusts are legal. They're disclosed to tax authorities, but they're structured in jurisdictions with strong asset protection laws that make seizing those assets nearly impossible. Second, offshore foundations. Foundations are similar to trusts, but operate under different legal structures. Liechtenstein and Panama are popular jurisdictions. Foundations allow for wealth to be held and transferred across generations with minimal taxation. They're commonly used by European billionaires for estate planning. Third, shell companies. This sounds sinister, but it's standard practice. A shell company is a legal entity that exists on paper but conducts little to no actual business operations. Wealthy individuals set up shell companies in places like the British Virgin Islands, Delaware in the US, or the Cayman Islands. These companies own assets, real estate, yachts, art collections. The beneficial owner's identity is separated from the asset. This isn't illegal. It's privacy. Fourth, investment migration programs, also called golden visas or citizenship by investment. Countries like Portugal, Greece, Malta, several Caribbean nations sell residency or citizenship in exchange for investment. You invest 500,000 euros in Portuguese real estate, you get residency. You invest $150,000 in Antigua's National Development Fund. You get citizenship. These programs are completely legal. Over 130 countries offered them, and applications have surged 64% in the first quarter of 2025. Fifth, cryptocurrency. This is the newest and most disruptive mechanism. 41,700 individuals now hold over $1 million in crypto assets. That's a 40% increase in just 12 months. 36 individuals hold over $1 billion in crypto, making them crypto billionaires. Cryptocurrency allows wealth to be moved across borders without banks, without government approval, without detection. A Bitcoin wallet doesn't exist in any physical jurisdiction. It exists everywhere and nowhere simultaneously. You can hold $1 billion in Bitcoin on a hardware device, the size of a USB stick. Walk across any border. Your wealth is intact, undetected, and instantly accessible anywhere in the world. This is why governments are terrified of crypto. It's the ultimate offshore tool, and the wealthy are adopting it faster than any other asset class. Roughly $14.4 trillion worth of wealth crossed national borders in 2024. Some of that was traditional banking, but an increasing percentage was crypto. The digital offshore era has arrived. Now, what are billionaires running from? Why is this exodus happening now? Because three forces are converging simultaneously: higher taxes, currency devaluation, and political instability. Let's start with taxes. Governments worldwide are broke. The UK's national debt is over 130% of GDP. The US owes $38 trillion. France, Italy, Spain, Japan, all drowning in debt. And when governments are desperate, they raise taxes. Not on the poor, on the wealthy, because that's where the money is. In the UK, the Nandam tax changes mean wealthy foreigners now pay full British taxes on worldwide income. Inheritance taxes increased. Capital gains taxes are being discussed. The signal is clear. If you're wealthy and you live in Britain, the government sees you as a revenue source, not a citizen. In France, wealth taxes, inheritance taxes, and income taxes combine to create effective tax rates over 60% for the highest earners. Emmanuel Macron has tried to reduce some taxes to stop the exodus. It's not working. The wealthy are leaving anyway. In the United States, proposals for wealth taxes, unrealized capital gains taxes, and higher corporate taxes circulate constantly. While not yet law, the mere discussion terrifies the wealthy. Because once governments start talking about taxing unrealized gains, the wealth on paper you haven't even sold yet, that's a signal that property rights are under attack. The second force is currency devaluation. Every major currency is being debased. The US dollar has lost over 98% of its purchasing power since 1930. The British pound, the euro, the yen, all declining in real terms. Central banks are printing money to cover government deficits. This creates inflation. And inflation is a hidden tax on savers. If you hold $100 million in a bank account and inflation runs at 5% annually, you lose $5 million in purchasing power every year. You didn't spend it. It was stolen through devaluation. Billionaires understand this. That's why they're moving wealth into hard assets, gold, real estate, commodities. And they're holding those assets in jurisdictions where property rights are protected. The third force is political instability. Brexit destabilized the UK. US politics have become tribal warfare. France faces riots and strikes. Germany is economically stagnant. Russia is at war. China is cracking down on private enterprise. Wealthy individuals are realizing that the countries they called home are no longer stable. And when you have hundreds of millions or billions of dollars, stability is everything. You don't care about ideology. You care about whether your assets will be there tomorrow. And increasingly, the answer in traditional Western democracies is uncertain. So the wealthy are moving to places where governments are competent, predictable, and pro-business. Places like the UAE, Singapore, and Switzerland. There's a fourth force that nobody talks about: moral hazard. Billionaires watched what happened in 2008 and 2020. Governments bailed out banks, printed trillions, created asset bubbles. The wealthy got richer. But they also learned a lesson. Governments will destroy currencies to save themselves. And when the next crisis comes, and it's coming, the response will be even more extreme. More money printing, more bailouts, more devaluation. Billionaires are moving money offshore because they don't trust their governments to act responsibly. And history proves them right. Now, here's what this mass exodus means for you. When the wealthiest people in a country leave, they take their tax revenue with them. The UK is losing $92 billion in assets from 16,500 millionaires. Those millionaires were paying income taxes, capital gains taxes, property taxes, VAT. That revenue is gone. Who replaces it? You do? The middle class? The ones who can't afford offshore structures. This is the wealth transfer nobody talks about. As the rich leave, the tax burden shifts downward. Governments need revenue. they can't tax people who aren't there, so they tax the people who remain. Property taxes increase, income taxes increase, new taxes are invented. Carbon taxes, digital taxes, wealth taxes. You can't escape. You don't have a golden visa. You don't have an offshore trust. You're trapped. And your wealth is slowly confiscated through taxes and inflation. Second, when billionaires move capital offshore, investment in your country declines. The wealthy are the ones who fund startups, invest in businesses, create jobs. When they leave, they take that capital with them. Economic growth slows, job creation falls, your country becomes poorer. This creates a feedback loop. The country gets poorer, so more wealthy people leave. The country needs more revenue, so it raises taxes. This drives even more wealthy people out. The spiral accelerates. Britain is in this spiral right now. So is France. Germany is entering it. And once the spiral starts, it's nearly impossible to reverse. Because you can't force wealthy people to stay. They have options. You don't. Third, currency collapse becomes more likely. When wealthy individuals lose faith in their country's currency, they sell it. They buy dollars, Swiss francs, gold, real estate in other countries. This selling pressure weakens the currency. A weaker currency means imports become more expensive. Food, energy, manufactured goods. Your cost of living increases. Your savings in that currency lose value, and you can't escape because your wealth is denominated in the collapsing currency. This is what happened to the British pound after Brexit. It fell 30%. British citizens holding pounds got poorer overnight. The wealthy who had diversified offshore were fine. The middle class was destroyed. Here's the timeline. Right now, we're in the acceleration phase. The exodus is visible. The data is clear. Millionaires are leaving at record rates. But most people don't notice because they don't track capital flows. They see billionaires on magazine covers and assume everything's fine. But behind the scenes, the wealthy are repositioning. In the next 3 to 5 years, the exodus will become undeniable. Governments will panic. They'll try to stop capital flight through capital controls, restrictions on moving money abroad. Wealth tax is designed to trap people. This will backfire. Y always does, because the wealthy will simply accelerate their exit before the controls take effect. In 5 to 10 years, the countries that hemorrhaged wealth will face fiscal crises. Tax revenues insufficient to cover spending. Currency devaluations, austerity measures. The middle class will bear the burden. By deaths to 15 years, a new global wealth map will emerge. The UAE, Singapore, Switzerland, and a few other centers will hold a disproportionate share of global wealth. The US, UK, and Europe will be poorer, relatively speaking. Their dominance will fade, not through war, through capital flight. So, what does this mean for someone watching these patterns unfold? The billionaires are using specific strategies that have become visible through the data. They're diversifying currency exposure across multiple jurisdictions. They're holding assets in different countries rather than concentrating everything in one place. They're acquiring properties and investments in stable regions with strong rule of law. They're converting portions of wealth into assets that exist outside traditional banking systems. These aren't secrets. These are documented patterns visible in migration data, real estate purchases, and offshore wealth reports. The wealthy maintain bank accounts in multiple currencies. They hold real estate in several countries. They structured their wealth across jurisdictions. They invest in assets denominated in different currencies, from Swiss francs to Singapore dollars to physical commodities like gold. Some have shifted percentages of their portfolios into cryptocurrency precisely because it exists outside any single jurisdiction's control. Others focus on building businesses and expertise that function across borders, creating value that isn't tied to any one country's economy. The pattern shows that wealth preservation during periods of instability comes from geographic and asset diversification, not concentration. The billionaires exiting their home countries aren't putting all their wealth in one new location. They're spreading it across multiple jurisdictions, multiple currencies, and multiple asset classes. This is observable behavior, documented in investment migration reports offshore wealth studies, and capital flow data. The wealthy are demonstrating through their actions what they believe about the future stability of traditional Western economies, and that demonstration is the largest voluntary capital migration in modern history. But here's what's critical to understand. This exodus isn't just about individual wealth protection. It's a signal about systemic fragility. When the people with the most resources, the best information, and the greatest ability to influence policy choose to leave, they're voting with their capital. They're saying the problems in these countries are at least on the timeline that matters to them. The UK can't reverse course fast enough to bring back those 16,500 millionaires. The tax policies are set. The political direction is clear. France isn't going to suddenly become low tax and business friendly. Germany isn't going to abandon its regulatory approach. These are structural problems that take decades to fix, if they can be fixed at all. And the wealthy aren't waiting around to find out. They're making decisions based on decades of planning, not election cycles. They're thinking about where their grandchildren will hold wealth, not where they'll be in 5 years. This is generational repositioning. The middle class doesn't have the same options. Most people can't just move to Dubai or Singapore. They can't afford golden visas or offshore trusts. Their wealth is tied to their home country through property, pensions, and jobs that don't transfer internationally. They're stuck in place while watching the wealthy exit. This creates two separate economies. The mobile economy of the ultra-wealthy who can move capital in themselves anywhere opportunity or stability exists, and the fixed economy of everyone else, trapped in their home countries, subject to whatever tax and monetary policies governments impose. The mobile economy is growing, the fixed economy is shrinking, and the gap between them is widening faster than at any point in modern history. This isn't about morality, it's about capability. The wealthy have options. They exercise those options. And the result is the largest peaceful redistribution of global capital we've ever seen. What makes us different from previous eras is the speed and the tools. In the past, moving wealth internationally required physical transport of gold, slow banking transfers, and limited options for where that wealth could go. Today, wealth moves at the speed of a wire transfer or a blockchain transaction. Jurisdictions compete aggressively for capital, and the infrastructure for international wealth management is more sophisticated than ever. The billionaire exodus isn't slowing down. It's accelerating. And every data point suggests it will continue accelerating until either the conditions in high-tax countries change dramatically or until there's nothing left to move. The UK losing 16,500 millionaires in 2025 is just the beginning. The question is how many will leave in 2026 and 2027? And whether governments will recognize the pattern before it's too late. Because once the spiral starts, once capital flight reaches critical mass, reversing it becomes nearly impossible. Confidence, once lost, is extraordinarily difficult to rebuild. And the wealthy, once they've established themselves in low-tax, stable jurisdictions, rarely return home. Let me end with this. The largest voluntary transfer of private capital in modern history is happening right now. 16,500 millionaires left the UK in 2025. China lost 15,200 in 2024. France, Germany, Russia, all bleeding wealth. And that wealth is moving to the UAE, Singapore, Switzerland, places that offer what traditional Western democracies no longer provide. Low taxes, currency, stability, political competence, and respect for property rights. This exodus isn't random. It's a response to decades of government mismanagement, currency debasement, and rising taxes. The wealthy see what's coming, and they're positioning to survive. The pattern is clear in the data. The mechanisms are documented in investment migration reports in offshore wealth studies. The destinations are obvious from the numbers. What's happening is that a global reordering of capital is underway. The countries that dominated wealth for centuries are watching it flow to new centers. The UK, which was the world's financial capital 100 years ago, is now experiencing the fastest wealth exodus in its history. France, which built an empire on its economic strength, is losing its wealthy citizens to Switzerland and Belgium. Germany, the economic engine of Europe, is watching capital flee to the UAE. This is what the collapse of the system looks like. Not bombs and invasions, bank transfers, and golden visas. Not dramatic and sudden, gradual and then accelerating. The wealthy are leaving, the capital is moving, and the countries being abandoned are facing fiscal futures they cannot escape. The billionaires have already made their choice. They've seen the data. They've consulted the advisors. They've run the projections. And they've decided that staying in high-tax, unstable, currency-debasing countries is a losing position. So they're leaving, taking their wealth, their businesses, their investment capital, and their tax payments with them. What's left behind are governments that need more revenue from fewer sources, middle classes that will bear increasing tax burdens, and economies that will slowly contract as investment capital drains away. This is the new reality. The age of trapped capital is over. The age of mobile capital is here. And in a world where capital moves freely, it flows to wherever it's treated best. The offshore exodus is accelerating. The data is undeniable, and the implications for countries hemorrhaging wealth are catastrophic. The billionaires aren't coming back. The question is how long it takes for everyone else to realize what that means.